Have you ever heard of names like Warren Buffett, Ray Dalio, or Jamie Dimon? These are some of the richest and most influential people on the planet, and their massive success comes down to one thing: making consistent and significant profits over the years. And one way to do it is through ETFs, or the exchange traded funds, which are essentially baskets of investments, meaning they are either stocks, bonds, or in today's case, commodities that trade on the stock market just like individual stocks. They even let you invest in entire sectors without having to pick winners or losers yourself. And in this video, we'll break down the 6 best commodity ETFs to buy and hold in 2025 that are perfect for those looking to hedge against inflation, diversify their portfolio, and capitalize on the booming commodity markets, all without the headache of picking individual stocks. So, let's get into it. Alright, first up on our list is the Invesco Optimum Yield Diversified Commodity Strategy number K1 ETF, or just PDBC, because let's be honest, you're not going to memorize that. Now, this isn't just some random ETF. It's one of the most popular commodity ETFs out there, and for a good reason. PDBC gives you exposure to a wide range of commodities. Think oil, gold, natural gas, wheat, and more, without the hassle of dealing with future contracts yourself. And the best part? Unlike some commodity ETFs that hit you with the K1 tax form, which is just an extra headache, this one keeps things simple with standard 1099 tax reporting. And believe me, this one is much simpler. Now to the real part. How has this ETF performed historically? Over the past 5 years, PDBC has delivered an average annual return of around 12.3%, depending on market conditions. If you had thrown $100,000 into this ETF 5 years ago, you'd be sitting on roughly $179,000 today. And that's without lifting a single finger. Now, commodities can be volatile, but with inflation still a big concern in 2025, having a diversified commodity ETF like PDBC could be a smart move to hedge against market uncertainty. Next up, we've got the iShares GSCI Commodity Dynamic Roll Strategy ETF, or just COMT. And I know these names really suck. Now, if you're looking for an ETF that gives you a broad exposure to commodities while also trying to minimize the painful roll costs that come with future contracts, this should be your pick. This ETF tracks the S&P GSCI Dynamic Roll Index, which means you're getting exposure to a mix of energy, metals, and agriculture commodities. But what makes it really interesting is that it actively rolls its future contracts to avoid steep contango costs, which basically means it tries to make sure you're not constantly losing money just because future prices are higher down the road. Alright now, enough build-up. Does this thing actually make money? Well, over the past 5 years, COMT has delivered an average annual return of around 9.4%, depending on commodity cycles. If you had invested $100,000 into this ETF 5 years ago, you'd be sitting on roughly $157,000 today. And again, that's with zero effort on your part. On our third pick, we've got SPDR Gold Shares, or just GLD. Finally, an ETF name that doesn't sound like a Wi-Fi password. This one is for those of you that are looking for the simplest way to invest in gold without actually buying and storing physical bars like a Bond villain. This ETF is literally backed by physical gold stored in vaults somewhere. So when you invest in GLD, you're essentially holding gold without the anxiety of securing it or insuring. The ETF will do that for you. Now, why is gold worth holding in 2025? Simple. It's the OG inflation hedge. Whenever markets get shaky, central banks go crazy with money printing, or geopolitical tensions flare up, gold historically holds or even increases in value. That's why so many investors use it as a safe haven asset. But let's talk numbers. Has GLD actually delivered? It actually has. Over the past 5 years, it's averaged around 11.5% in annual returns. And if you had thrown $100,000 in gold 5 years ago, you'd be sitting on around $173,000 today. And again, all while doing absolutely nothing. Now let's talk about the United States Natural Gas Fund, or UNG, because let's be honest, nothing screams excitement like natural gas. But hear me out. This ETF is a pure play on natural gas prices, meaning if gas prices spike, so does UNG. And with the global push for cleaner energy and the growing demand for natural gas as a transitional fuel, this ETF could be a serious winner in 2025. UNG works by tracking natural gas future contracts, which means it's a bit more volatile than something like GLD. 1 month, you're up 20%. The next, you're down 10%. But that's the natural state of commodities. High risk, high reward. And for those who can stomach the swings, UNG has had some massive runs in the past. Now, let's get to the good stuff. Has this ETF actually made money? Over the past 5 years, UNG's performance has been a roller coaster, but in strong natural gas markets, it's seen gains of 22% in a single year. If you had put $100,000 in UNG 5 years ago, at its peaks, you could have had over $200,000, though timing is key with this one. Next on our list, we've got the WisdomTree Efficient Gold Plus Gold Miners Strategy Fund, or GDMN. And yeah, I know, these names just keep getting worse. But here's why this one stands out. It doesn't just invest in gold like GLD. It takes things a step further by mixing physical gold and gold mining stocks in one ETF. Think of it like getting the best of both worlds. While you get the stability of gold and the explosive upside of gold mining companies. Now, why does this matter though? Well, when gold prices rise, gold miners tend to outperform the metal itself, sometimes doubling or even tripling gold's gains. And GDMN takes advantage of that dynamic while also keeping a chunk of its portfolio in physical gold to reduce volatility. Now, let's talk numbers, shall we? Has GDMN delivered? In strong gold markets, this ETF has posted returns north of 15% per year, outpacing regular gold ETFs. If you had invested $100,000 5 years ago, you'd be sitting on $201,000 today, assuming you held through the gold booms. For those who want exposure to gold, but with a little extra firepower, GDMN is definitely a solid choice for 2025. All right, last but definitely not least, we've got the iShares S&P GSCI Commodity Index Trust, or GSG. And at this point, let's be honest, you are probably exhausted by these ETF names, which seems as if they are just random letters thrown together. But here's why GSG makes the cut. It's one of the simplest and most direct ways to get broad commodity exposure without picking individual assets. This ETF basically tracks the S&P GSCI Total Return Index, which is heavily weighted toward energy, but also includes metals and agricultural commodities, which in short means if commodities boom, GSG rides the wave. But how about the performance side? Well, for starters, commodities go through cycles, and GSG has definitely seen its ups and downs over the past few years. But overall, it has returned an average of 10.8% annually. So if you had invested $100K 5 years ago, you'd have around $167,000 today, with some years seeing even higher returns. Why does this matter for 2025? Inflation, supply chain issues, and growing global demand for commodity means prices could see another surge. So, if you want an ETF that gives you broad, diversified exposure to raw materials, GSG is a solid way to round out your portfolio. And there you have it, 6 of the best commodity ETFs to buy and hold in 2025. Whether you're looking for broad exposure, inflation protection, or high growth potential, there's an ETF for you on this list. And with that being said, commodities aren't always the flashiest investment, but they play a crucial role in a well-diversified portfolio, especially when the markets are uncertain. Thanks for watching, and I'll catch you in the next one.